Hi, Les Goss here. Today I'd like to walk through a property evaluation of an actual apartment here in Colorado Springs that's for sale. We're not going to do much on the due diligence part of it. This is just going to be the numbers. We're going to try and find out if it's worth pursuing at all, and if so, what price might make sense for us. So let's jump in. First of all, it's a 30-unit apartment. They're all 2 bedroom, 1 baths. The current owner did a whole lot of updating in 2009. It does have flat roofs that over the next few years undoubtedly will need to be replaced, so we have to keep that in mind. 2 units did not get fixed up in the last update, so I've set aside $5,000 a piece to get those things back up and ready to rent. The rents are slightly below market rate, so they could be raised up a little bit right now. He's asking $1.25 million. He got a good deal on it, but the last time it sold at full price was $1.6 million in 2002. Here's our assumptions. These are the numbers we're going to plug into our spreadsheet, so it'll pump out numbers that we can actually believe in. The first line here says 65% loan to value. That requires us to bring 35% to the bank as a down payment. We're also setting aside $100,000 in reserves. This will finish up the last 2 apartments that need to be fixed, hold in reserve some money to do the roofs, do some maintenance and cosmetic work on the outside, and have some backup funds for a rainy day. You just never know. $35,000 is what we're projecting as closing costs. We're putting in a 3% annual rent increase into the spreadsheet, even though it's currently looking like that's going to go up even faster for a few years. We'll leave it right at 3% to be conservative. Our expenses we're projecting will increase about the same as inflation, which we think will be about 2% for the next several years. The vacancy rate in town is now below 7%, but again, being conservative, we're going to say it'll be 8%. And we're going to put in $3,000 per apartment for expenses each year set aside into our plan. This is about twice what the current owner has been putting in, but we don't think he's been putting in quite enough to maintain it properly. So we think $3,000 a door is a better price. So this is all going to go into several sheets of a big spreadsheet, and I'm going to show you 4 of them right now just in a highlight fashion. The first one is the annual property operating data. This is nicknamed the APOD. It just allows you to put in the purchase price, your acquisition costs, how much your loan's going to be, your mortgage payments monthly, and this page goes on and on and on way down, and it will show you all the income and expense centers for the property for an entire year. Then this one, the cash flow table runs the same numbers that you've entered before, but it'll take everything out to 10 years. And it will show you at the bottom cash flow before taxes and cash flow after taxes. This is assuming a 35% investor tax bracket. Again, we won't go into all the details, but just to show you what the spreadsheet basically looks like. Next, we come up with 3 different sales scenarios when we're going to sell it. I've put it in at selling at a 7 cap, an 8 cap, or a 9 cap. So we've got a range to choose from. The center one, the 8 cap, that basically means we're taking the 10th year net operating income dividing by 8%, and that gives you $1.9 million to sell if we sold this in 10 years. Then the internal rate of review chart shows the amount going in and the amount cash flow each year, all the way down the sales price, and then it'll calculate that if you hold it for 10 years and all these numbers come true, you would have over 20% return before taxes. Now we're going to compare a couple of ways to buy this thing. First of all, we're going to offer $100,000 less than what he's put up as his asking price of 1.25. We'll offer 1.15. With our 65% loan, our 35% down payment, and 135,000 of upfront expenses and reserves, we need to come up with over $535,000. That gives us a cap rate of 9.32. This passes one of our criteria, being we want to buy something with at least an 8 cap or higher, so that qualifies there. Our cash on cash return, this is the amount of return compared to the amount that you put in. And at 9.19%, that's lower than we'd like to see. We want to be up closer to 12. So that's not something that grabs our fancy right there. There's our sale price again that we just mentioned. Once we take out everything we owe and all the taxes, and not the taxes, but all the expenses of selling, we put in 7% of the sales price for that. We come up with $1.2 million at the closing table to us, which makes a before-tax internal rate of return of 16.17%. Now, if we offer $950,000, our upfront cash required goes down by $70,000. Our cap rate goes way up, 11.26%. That's virtually unheard of right now for a property in good shape. The cash on cash return now gets up over 12% where we like it. Sale price stays the same, since what we buy it for has nothing to do with the sales price. But our before tax profits go up by $100,000, and our overall return goes up to over 20% for the bottom line return. So that's what we look at. I'm, like I say, only giving you a very high level look at this. We're not going to try and go through all those spreadsheets, because it's enough to make your eyes glaze over, especially on a computer screen. But you can tell that if we could get this for $950, it looks like a pretty darn good deal. We'll talk to our investors and broker and see if we should put an offer on this, and we'll let you know. In the meantime, thanks for watching. If you've got any questions, email or respond in the comment if you're on the website, and we'll talk to you later. Thanks. Bye.